3 dividend-focused ASX stocks to buy in 2020. What is up everyone, it's David here. Now about a month ago, I created this video and you guys have really enjoyed that. So I decided to challenge myself to find more dividend-focused ASX stocks that's really worth your attention. And at the end of this video, I'll also update you on my Australian and US dividend growth investing portfolio and just a bit of market news to finish off the video as well. Now without further ado, let's go. Okay, so the first one is Rural Funds Group. They are a diversified REIT in Aussie agriculture assets. So think renting real estate to essentially really experienced farmers. So just a bit of extra information before we look under the hood. The leases that they have with their farmers are on average 11.3 years. And they have fixed rent increases built into those leasing contracts. Now, their objective as a REIT is to grow their dividend distribution by 4% every single year. And the dividend yield is 5.49% at the moment. So let's start off with the earnings over the last 5 years. At a 21.4 earnings growth over the last 5 years, that's pretty damn impressive. A big part of their earnings growth is coming from almonds and cattle farms. On top of that, at the end of 2019, JBS, which is the world's largest meat processor, have requested Rural Funds Group to increase their supply arrangement because their business is growing. So let's dig a little deeper into their balance sheet. So from a single glance, we know that the short-term assets well cover the short-term liabilities more than 2 times actually. And combining that with a long lease contracts of 11.3 years is actually 11.5 years in their recent half-yearly report. So it seems like they really shouldn't have any problems weathering the storm over the short term. Okay, so let's dig into the debt to equity ratio. So it seems like from a debt to equity standpoint, for every 56 cents of debt, there is $1 worth of equity. That's pretty safe in my opinion. And if we look at the dividends that they paid over the years, it's been pretty consistent and it's definitely been growing 4% year on year. So when it comes to economic moat, Rural Funds Group have one of the biggest advantages, and that's switching costs. Switching costs for farming operations and agriculture in general is extremely expensive.
I mean, what is a farmer supposed to do? Move the cattle to somewhere else so that they can farm, or pull out their almond trees and plant it elsewhere?
It's just incredibly expensive to switch to another real estate. And on top of that, it's extremely capital intensive to enter into a real estate business, not to mention the amount of expertise that you need when it comes to farming operations and also agriculture. So the high barrier to entry on top of high switching costs, it makes it really hard for any new entrants to compete properly against Rural Funds Group. Another really interesting thing is their insider trade volume. So in the last 3 months, the CEO David Bryan have bought almost $250,000 worth of stocks at approximately $1.74 per share. And on top of that, an independent non-executive chair, Leslie Paintner, have bought $699,000 worth of shares at $1.77 over the last 6 to 9 months. The thing to remember when it comes to an insider purchasing at a certain price and usually at that big of a volume is that that's an indication to their confidence in the company's future. And on top of that, they believe that the value of the share is worth more in the future. Now, when it comes to the future prospects on the fundamental level, agriculture, in my opinion, is a little bit more resilient in tough economic times. But they are more prone to environmental risks like bushfires or droughts. At the end of the day, we gotta farm our own food, right? I mean, we have to eat. Plus, the country outside of Australia know us for the quality of our meat, wool, and wheat. And they're willing to pay a premium for it. And trust me, if you try to convince any Asian parents to move from Australian beef or Penfold to another brand or made by another country, I can promise you that it's extremely hard to do. The products that's coming out of our country is attached to the word prestige and high quality. So I definitely think the prospects of Australian agriculture is bright and there's plenty of room to grow. Now the second stock is super meta, and that's Australian Stock Exchange. This is our largest multi-asset exchange in Australia. So a bit of information before we look under the hood. The Australian Stock Exchange make money 4 ways. When you trade stocks, options, or derivative contracts, they take a cut and they make money. When a new company gets listed on the stock exchange, they take a cut and they also make money. When your stock gets matched to a buyer or a seller, they settle the transaction and then take a cut from that. When a company uses their technical infrastructure, data sets, or even analytics, they also make money on that. Basically, they make money on anything you or a company does that has to go through the exchange. And the yield is currently at 2.62% at the moment. So let's start with the earnings. Over the last 5 years, they have grown their earnings 4.5%. In their most recent half-yearly report, it's shown that the revenue is up 7.1% because of the increased trading activity. Okay, so let's look into their balance sheet. So from a single glance, there is enough short-term assets to cover both short-term liabilities and long-term liabilities. So they shouldn't have any issues weathering the storm for the remainder of the year. From the debt to equity standpoint, I can't even comment on that because they have no debt. And on top of that, the dividend history has been pretty impeccable. I think the most interesting thing is their economic moat. So the Australian Stock Exchange arguably have a monopoly when it comes to trading, capital raising, or settlement services. Sure, over the years, there's been a couple new competitors entering the scene, which is KaiX and also National Stock Exchange of Australia. But in my opinion, ASX is just too big at this point. And they have three very distinct moats that is incredibly hard to erode. The first one is they have the scale and infrastructure to have an absolute advantage over all of their competitors when it comes to costs, which in turn also gives the power to Australian Stock Exchange to price how they want to when it comes to their services. Now, on top of that, because of the sheer number of companies that's listed on the ASX, they have a network effect advantage along with a brand that people can recognize when they need to raise capital. Network effect is essentially when more people uses a service, the better that service gets. So think of Facebook or any social network. The more of your family or friends move onto the platform, the better that service becomes. Now, the ASX network effect gives them the depth of market, which means that there are a lot of buyers and sellers on the ASX. And having that allows company to raise more cash more quickly. When it comes to the future prospects of ASX, I don't think I need to comment too much on that. ASX is not going anywhere in the next 20, 30, 40, or even 50 years as they implement and trial distributed ledger technologies, which is blockchain, along with more analytics offerings and a faster settlement. It's just going to be really, really difficult for any new entrants coming in to make a dent in that business. Now, the third one is Sonic Healthcare. So Sonic Healthcare provides medical diagnostics, administrative services, and basically facilities for medical professionals. They make majority of their money via lab testing, and they have operations in UK, US, Australia, and also in some of the countries in Europe. Their current dividend yield is approximately 2.98%. Now, because they are in diagnostics, the demand for their services have benefited from the public health crisis. And they have also recently just won a government contract in Australia to provide rapid testing for aged care facilities. So over the last 5 years, Sonic Healthcare have grown its earnings by 8.8%. So let's dig a little deeper into their balance sheet. Now, just from a single glance, it seems like there are $600 million off from covering their short-term liabilities. Now, because of the health crisis we're in, and also the fact that they've just won a government contract, and their operations in other countries are also growing very quickly, I'm willing to turn a bit of a blind eye to dig a little deeper to see what else is under the hood. From a debt to equity standpoint, it seems like for every 50 cents of debt, there is $1 worth of equity. So pretty safe in my opinion. Dividend history, very consistent, and honestly, that's just a very good looking graph. And it shows that they have a great track record when it comes to navigating turbulent environments or multiple recessions events and still able to grow their dividends consistently. The major economic moat Sonic Healthcare have are their facilities. The sheer number of facilities in US, UK, Australia, and some of the European countries gives them a cost advantage to provide services at a cheaper cost. And when it comes to future prospects, with testing in general, I think that the world as a whole have learned a lot from this public health crisis. And post-pandemic, I think that countries will have a tighter regimen when it comes to testing and also deploying testing at scale to mitigate and manage outbreaks like these in the future. And I think that Sonic Healthcare, along with pharmaceutical companies, will play a major role when it comes to preparation for the future as well. So I'm definitely optimistic when it comes to the future prospects of Sonic Healthcare. Okay, so before we wrap up this video, I want to give you a quick update on my Australian and US dividend growth investing portfolio. Now, on the Australian side, on the 30th of May 2020, my portfolio is worth approximately 49,000 Australian dollars. Over the last week, the banks have rallied along with resource companies and also some of the travel sector. So the recovery has definitely benefited Argo Investment and Milton Corp. If you watch some of my previous episodes on the weekends, then you know that my Argo Investment and my Milton Corp positions were very, very deep in the red. So is WAM Research actually. So besides Argo Investment and Milton Corp, not much is really happening. I mean, VTS, which is an exchange traded fund that tracks the total US market, they're just humming along because the tech giants over in the US represents over 20% of S&P 500. So it's almost more of a reflection of how the tech companies are doing rather than the rest of the market. So I'll be interested to see as the stimulus packages over there slow down for the rest of the year or even later in the year, how would that impact the US stock market? Now on WAM Research, the interesting thing is that if you look at the top 20 holdings, some of these companies like Breville, CityChick, Tassel, TPG, Cleanaway, and Maya have shown its resiliency in this public health crisis. Some have actually benefited more because of this pandemic. As we're spending a lot more time cooking at home, Breville Group has benefited from the fact that we need more kitchen appliances. And similar story to TPG. As we increase our internet usage, there's a stronger demand for TPG services. So what's really interesting with CityChick is that over the last couple months, if you work in the digital marketing field, you really should notice the cost of advertising have dropped quite significantly. And that's mainly because a lot of the bigger players with bigger budgets have cut their marketing costs, or some have even pulled out from advertising online completely. So this has created an opportunity for e-commerce brands to get access to cheaper advertising on Google and Facebook, which essentially allows them to acquire brand new customers significantly cheaper. So this is my most up-to-date US dividend growth investing portfolio with stake. Over the last week or so, the portfolio has just been humming along quite well. BlackRock has definitely benefited from the Federal Reserve buying corporate bonds from them exclusively. The Federal Reserve in the US is the equivalent of our Reserve Bank of Australia. Now, Dropbox and GoPro are not dividend stocks at all. They are just free stocks given to me when you sign up for an account with stake. I'm not sponsored by them at all. I just use them to do majority of my US stocks investing because it's easier and frankly it's cheaper. So if you want to try this for yourself and wouldn't mind getting a free stock in Dropbox, GoPro, or Nike, I'll leave a link in the description box below. Home Depot will continuously benefit from this pandemic. People are spending more money to improve their backyards because they're spending more time at home. And some of them are even just choosing to work on small projects because they want to do something besides working at home. Similar story when it comes to Prologis and Realty Income. Prologis is an industrial logistics REIT. And frankly, I think when it comes to industrial and logistics REIT, they will perform well no matter the times are good or bad because they're such a key part to our supply chain. But they have benefited even more during this time because there's a heavier reliance on e-commerce. Overall, I'm pretty happy with both my US and Australian dividend growth investing portfolio. I'm just gonna keep dollar averaging into it. And as of recording this video, I'm expecting approximately $250 worth of dividends per month. Next month, I'm gonna add to the portfolio again. So I'll update you again next month what my new expected monthly dividend will be. At the end of the day, I'm not a professional. I'm just a bold Asian guy making investing videos on YouTube. So don't take this as financial advice. This is just purely for your entertainment purposes. So before you go, I just want to let you know that I really appreciate you coming back to watch my videos every week and gently smashing that like button. No, in all honesty, the love that you show me in the comment section and also the like button have helped me understand the type of content that you enjoy and the type of content that you don't really enjoy. I'm still learning how to create engaging content for you. And if you have any feedback when it comes to how I can make my videos better on some of the future topics you'd like me to cover, let me know in the comments below. So as usual, if you enjoyed this video, gently smash that like button and subscribe to my channel, click onto the bell so that when I release more portfolio updates and more videos like this, you be the first one to know. Otto is gonna do the honors. And until next time, see you very, very soon.